Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the podcast. Glad to have you on here today. And today I wanted to share a short presentation that I did at a recent event that I spoke at. I was actually up in Boston and spoke at the Smart Real Estate Coach Conference hosted by Chris Prefontaine, Zach Beach, and then Nick Prefontaine. They do a really great job. And Chris and his team and his what they teach really matches up well with what we teach when it comes to the crossover. Obviously, with a lot of the note stuff that we buy, distressed debt, stuff like that, matches up well for potential subject to deals when we're getting lists of non-performing notes that necessarily we don't want to buy, but could be potential great deals when it comes to subject to owner financing, lease options if you're not in the state of Texas, stuff like that. So I thought I would share because Chris asked me to come up there and spend the time talking about what we're seeing in the market, kind of the tea leaves. And if I had a glass ball, what I see in the future. Well, I thought I'd go through it because I think you guys will find it very interesting, something to talk about, and something that you should maybe think about focusing on in 2025 and beyond as we get rock and rolling here. So let me share this here with you real quick because it's important for you to keep in mind. Okay. So I titled the conversation, "What are the debt markets telling us?" And why do I look at the debt markets? Well, the debt markets, you see things 6 to 12 months ahead of what most investors are chasing. Now, what are most investors chasing? You're chasing distressed borrowers. You're chasing foreclosures. You're chasing probate leave where somebody's passed away, right? Or you're chasing people who are, out of town owners, ton of equity, absentee owners. Well, when you target the debt markets and you see what's going on in the debt markets, that gives you a lot of information way ahead of everybody else. We're talking 6 to 12 months or longer compared to what most real investors are doing in chasing the foreclosure lists or the list pendants list if you're in a judicial state. But if you're in a state like Texas, things move fast here. 21 days to foreclose. We don't have a notice of default that gets filed like of a lot of other states. The first Tuesday of the month represent a huge amount of opportunities to us here if you're chasing foreclosures. Whether it's tax sales or the traditional mortgage foreclosures, you got to show up with cash. So anytime you can get more information ahead of time or opportunities that most people don't tap into, and guess what? You're ahead of the curve. And that's what I've always loved about, especially in the note business and investing in Texas, is I don't have to wait till the foreclosure filing is filed. We'll see stuff way ahead of that. So that puts us in a good position when it comes if we start targeting that stuff. Now, for years, we've just targeted basically, hey, we're going to target the debt, buy the debt, work it out with the homeowners in some sort of modification or foreclosure. But with what's going on in the market, there's things and opportunities that we see that I think you need to be aware of, whether you're just a traditional real estate investor in the Lone Star State, or you're looking to dive into investing, or you're outside of Texas looking to buy stuff in Texas, other areas. Here's some opportunities I want to go through with you. So what are the debt markets telling us? Well, first and foremost, there's always a talk about how interest rates, I've got a sub 6% interest rate or sub 3%, and I'm not going to move out. Well, those days of where the majority of Americans who have a mortgage on their house that's below 3% because so many people financed or bought properties 2 years ago, that number is changing. Here in the next quarter, they're predicting Q1 of 2026. The amount of people that have a 6% or greater mortgage is going to be greater than those with a 3% or less mortgage. Now, for the last 5-6 years, it's always been the opposite way around, where you had people that had lower interest rates on their mortgages dominated what was out there, right? Well, that's changed. People are having to sell. People actually are defaulting on these mortgages. Surprise, surprise. They're having a hard time. They bought more house than they could afford, or their incomes have been changed in a variety of ways, losing jobs, losing the second household income. The gig economy of Uber and Facebook Marketplace and all that stuff is really drying up as things aren't being as productive as possible, or they're not profitable as possible, I should say, as those things have adjusted their income or their compensation levels to gig economy workers. I mean, people are tired of eating out or tipping 20% at a to-go menu. You know what I mean? So people are doing less of that stuff because they're saving money, but you're starting to see that reflected as now mortgage people with the higher rates mortgages because they're having to buy now, having to do something, are going to surpass the sub 3% here in the next Q1. All right, in the next quarter too. So that's something to keep in mind because we always talk about that. Well, that's not always the case like it has been. Okay, now let's talk about delinquency rates here, and this is as of Q2 2025. I don't have the Q3 results out when we do. We'll actually obviously do an episode about that. But here's the Q2 2025 delinquency rates. And FHA loans are at about 10.57%. Now that's that should scare you. FHA loans are primarily, they're not subprime borrowers, but they're usually first-time home buyers, right? And at a default rate of 10.57%, that number keeps climbing up. And that's a default rate for somebody that comes in either they either bought too much house, they've been the most impacted because they got in with the least amount down. They're also ones that probably are floating bills a little bit with credit cards, student loan debts, auto loan debts, though all that stuff is at all-time highs. But when you see a 10% plus default rate, that's not a good sign. That's where you're seeing more foreclosures. We're seeing more distressed stuff in that neck of the woods coming across our books. Look at VA loans. Those are at 4.32%. That's also very scary in a default rate. Now, conventional loans still are low. Your conventional 30 years are still at only a default rate of 2.6%. But what you have happening with that is, like I said before, the house of cards of debt when it comes to this country with other things in default. We are seeing that starting to tick up too. Foreclosures are starting to tick up on the conventional route, just, in other areas of the country, but also here in Texas, in Dallas, Bear, Harris County, Houston, stuff like that. So Houston, San Antonio, Dallas. We're not seeing it so much here in Austin. A little bit of tick up, but not like it's been before. Now, what states with the highest increase in mortgage defaults and foreclosures? What states have the highest stuff? Let's go through that stuff here for you, because that's important to know, especially if you're listening to this outside. Now, the states at the highest increase in mortgage defaults and foreclosures: Florida, no surprise there with insurance and a lot of investor money out of that area. Condos definitely in that area. Mississippi, North Dakota, Ohio, Michigan. Now, why does North Dakota stick out there? Well, because you have a lot of people moving there for fracking oil and have moved out of there, okay? Ohio and Michigan don't really surprise us with the most amount of foreclosures. They're always going to have some stuff up there. But then you start getting into West Virginia, New Jersey, California, New York, and Louisiana. Those states all have an uptick in foreclosures as well. Now, one of the things that we did recently is that we pulled a report talking about where the markets are going to go. Actually, we got it from a buddy of ours, Nick Gurley with Reventure Capital. He provided to us, and we started diving into it. And so it breaks down really kind of how overpriced markets are right now and predicting where they're going to go in the next 12 months. Now, 855 cities, that's a lot of cities to look at, anywhere, like down to like 10,000 people, 20,000 people. So what we thought we would do is let's just look at the top 50 and then compare those numbers to overall the 855. So if you look at the top 50 markets, on average, properties are overvalued by an average of 16% right now. They're overvalued by that amount. That's if you take all top 50 states out there. Now, the lowest of those is Baltimore, Cleveland, Sacramento, Chicago, and Washington, D.C. They have the least amount of overvalue. But those that have the highest overvalue are Atlanta, Charlotte, Columbus, Buffalo, and Detroit. They're the highest in overvalue. So it goes up more than 16%. All right. Now, you can expect price cuts values to drop by 25% average across the top 25 states. We've seen some correction here in Austin, seen that in San Antonio, Dallas, Houston as well. But they're expecting the values to drop by an average of 25% across the top 50 markets. The lowest price cuts are going to come in Buffalo, New York City, Chicago, Providence, Rhode Island, and Milwaukee. Okay. Those are going to be the biggest, the least amount of price cuts because New York City real estate doesn't really change. You've got even when the markets go up, you still have value there because it's such limited availability. Chicago, I don't see a lot of price cuts going there too. You are starting to see a bit of an increase though, or slowing in purchases in Chicago because of all the ICE raids and stuff like that taking place. Providence, Milwaukee kind of stay the same. The highest price cuts are going to be the ones that have the most amount of distress right now. Phoenix, Denver, Salt Lake City. Honestly, all the bigger markets in Texas are going to see a huge price cut. Vegas, Portland, and of course, Florida. God's waiting room and the Lone Star State. I just threw those in there because all the cities in there really are seeing big, like 35, 40% drops in some cases. Now, look, don't sit here. We just talked to my buddy Boyd Pops, who's a realtor here, talked about how we've seen only really a price correction about 5% here in Austin. We're overvalued here. It's a little bit of a correction, and things are moving, especially in that sub $400,000 range. This takes in consideration basically every property there in these cities, not just a specific price range. Okay. Now, if you take and compare it to the top 855 cities across the United States, it's overvalued by an average of 14%. Okay. And we're seeing a price cut about 22%, so a little bit less. Okay. Now, when we look at the top 855 cities, it's overvalued by an average of 14%. Price cuts average of 22%. We talked about most undervalued area, according to the top 855, is the rural Mississippi market and Texas in the Rio Grande Valley. That's down Laredo, down that neck of the woods down by the border. South of Corpus Christi, basically. Okay. Harlingen and that area down south there. So that's where the most undervalued areas are. Now, the city with the least price drop that they expect is actually Rochester, New York, all the way opposite up to New York and Rochester, not Minnesota, Rochester, New York, which is only expecting about a 5.4% price drop out of all the 855 cities. Now, Rochester obviously has a lower price value for homes. There's a lot of people going in, buying there, turning them into rentals. I don't buy a lot there. It's Rochester. Not necessarily want to own a $20,000, $30,000 property in an area that takes forever to evict in a lot of cases. So, but some people are doing well. But that's the thing to look at it. Now, like I said, seeing deals that come in 6 to 12 months faster than most of your investors. Now, like I said, we get lists in all across the country. We get anywhere from like a one-off note up to, like, we just received a list of 636 non-performing VA FHA loans. Okay. Now, the average interest rate, to see a bit of an idea, comes out about 5.13. And that ranges from sub at 3% to 2.75%, all the way up to 8% on the interest rates. 180 of these are beyond 12 plus months in default, where they haven't paid in over 12 months. 456 of them are 90 to 270 days in default, so from 3 to 9 months in default. And then when you look at when these loans were originated, they've originated as far as back as 2009, all the way up to something that's basically just 90 days behind. It's originated this year, but it's already behind. Okay. So the average of these, based off of what they have anywhere from like a 79% loan to value, as low as a 2% loan to value, all the way up to 130% loan to value, where they owe more than the property's worth. Okay. But average across the board, they've got about 20% in equity. All right. Now, that's as it sits today. If markets drop 20%, that equity is going to get obviously squeezed to 5, 10, 15% in some areas, or you may be negative equity over the next 12 to 24 months. Every market's a little bit different. So what I did is I took this 636 and I kind of mapped it so you can kind of see geographically speaking. Now, these, out of the 636, there's 256 of them. Okay. Just under, really about 40% of them that are 90 to 120 days past due. These are where it's just the cusp of now that the lenders are starting the foreclosure process. Now, some opportunities here. Would it make sense for me to buy distressed debt when they're only 90 days behind? No, it does not. I'm not going to pay a premium for that. That just doesn't make sense, because that's really the cusp of when people can either A, get back on track, or they got to get serious about delaying things, and the bank's going to start the foreclosure process, or file the list pendants, or the notice of default, or start looking when the first Tuesday in that next month is in Texas. But it does lead to great opportunities for other avenues, other niches of real estate investing, specifically when you can see things that have a lower interest rate. Like I just showed you, the average of these is about 5.11%. That's lower than about current mortgage rates at about 6.5%, give or take a little bit. So those potentially, especially when they don't have that much in default, but people are walking away from them, they can't afford it, these become great opportunities for subject to deals. And by subject to deals, that's taking over the debt, getting somebody out that can't afford the property to avoid a foreclosure. You're taking over the debt. All right. The loan still stays in that borrower's name. But as we know, late pays will affect their credit for 24 months. Okay, it's better than a 7-year foreclosure process. So these are opportunities for you to come in, work with the borrowers, get them out of a property they can't afford anymore, maybe give them some cash for their equity, take over a low mortgage payment through like a land trust, so you're not violating due on sales clause and then assigning the land trust to you, of taking it over and then either turning around and renting it out for cash flow or doing like a wraparound mortgage. If it's at 5%, turn around and wrap around it at 7 to 8%. So you've got a nice gap there between not only the interest rate, but also the price point of what you finance it at values today versus what it's at in the unpaid balance aspect of things. So you've got this arbitrage between the two so that you hold it for a couple, let's say 2-3 years. Not only are you getting a down payment, you're also getting the equity increasing and principal balance being written down as profit, but then also getting the monthly cash flow. So there's really three paydays on the subject to lease option kind of thing where you wrap around and turn around. I like the 3 paydays when it comes to buying a note. You get some skin in the game from the borrower. They're making monthly payments to you, and then you get a payoff in either 36 months when they refinance you out. Okay. Or you sell that note off to another investor. But this is great opportunities here where they're 3 to 4 months past due, potential for subject to deals, and it's all across the country, not just here in Texas, but a lot in Florida, Midwest, all across the country. Even for folks out in sunny California, you got some opportunities there. Now, out of this other tape, there's 188 of them that were anywhere from 4 to 12 months in default. Okay. Now, could these still be potential opportunities for subject to deals? Yes, you can still do that if you got some skin in the game, or have some investment money to actually offset the late defaults. These could also be potential modifications. I don't really see that the banks are going to do too many modifications to low interest rates, but more of a forbearance agreement where they take the payments they're behind and put it back to the thing. That's the thing, is knowing the debt markets that I do, knowing what people are potentially buying this stuff at or what the bank's motivation is. You get on the borrower side, these can be potentially great deals for you. Like I said, some equity, some more motivation. A borrower may not be willing to play ball with you when they're just barely behind, but once that foreclosure notice files or starts, they get a whole lot more motivated to do something with it. Now, are some of these people, could they turn around and potentially sell their house for sale? Yeah, but we all know houses just aren't moving right now. Okay, it's not the same thing as it was a year, 2 years ago. Now, there's also 180 of these that were beyond a year in default. They are potential foreclosures for you. These are deals that you track for the foreclosure auction or track against, say, cash for keys. If they've got some equity, get the investor to deed over to you or do a hard money loan to buy them out and get them on their way. I mean, yes, could the sellers potentially make some money at the foreclosure auction? Yeah, but let's face it, as foreclosure are going up, less and less people are going to be bidding. There's the opportunity they're just going to lose everything. So these also can be the potential subject to deals, owner finance deals, distress stuff where you can bring a borrower into it and arbitrage it or do lease options, stuff like that. So plenty of opportunity for you to take advantage of. Now, that's why, we've got a variety of different reports. If you follow me on LinkedIn, you'll see that we post these things on a regular basis. The podcast, obviously, there. We've got a free 1-day note investing class that we teach on a regular basis. Go to noteweekend.com. I'll send you a 2-hour replay to it. We're here to help you out and take your business to the next level. But the thing that you have to realize, ladies and gentlemen, that seeing the stuff that comes to me, like I got another list of 133 notes this morning with 30 of them in Texas. I got another list in Friday, on a bunch of reverse mortgages where the borrower is deceased with a chunk in Texas. So I love Texas. It's my home state. Lots of opportunities here. I buy also in Indiana. I bought in Florida. I bought in Oklahoma. I bought in the Carolinas. I bought in about 20, 30 states. No matter where you're located and where you're watching this from, there are opportunities. The thing is, you just got to get out of your own way what you can or can't do and realize the opportunities out there. And that's why I like the debt space there for you. So, because we're seeing stuff, like I said, 6 to 12 months ahead of most investors. There's less competition there. There's still some competition. I'm not going to lie. You got to bid it properly. But even if I can't buy that debt on this stuff, it becomes opportunities for me to target for subject to deals, real tool referrals, lease options, and a whole variety of different things depending on what's going on in that state. So if you like that stuff, please feel free to reach out to you. Make sure you hit the subscribe button and follow us, and go out and take some action, and we'll see you at the top. Bye, everybody. Hey, real estate investors. So you want to dive into the world of note investing, but don't currently have the funds to sign up for an expensive class or a workshop or one-on-one coaching. Well, then you definitely want to check out the biggest bang for your buck in the note world, and that's our WCN membership. It gets you an all-you-can-learn access to our class workshop replays, tapes, weekly coaching calls. For $97 a month, it's the biggest bang in the note industry because you get access weekly with me. You can book one-on-one phone calls with me. As we get different tapes in, we'll share them with our members after our one-on-one coaching students get access to us. We share a variety of tools, like I said, replays to the previous workshop, special discount codes to other events that you can take advantage of to help you get more bang out of your dollar every month. We've been investing in notes for over 20 years, and one of my biggest passions is helping note investors, big and small, get started buying notes. Yes, I got started years ago with no money, no savings, and no list. And I love helping people close on their first deal, get their first private funding partner to help them fund more deals and help them both make above average returns. If you're looking for somebody to help you take your note investing from 0 to 60 and want to get started, my WCN membership is a great place to get started. Like I said, we upload lists to it, video training, coaching calls for $97 a month. What can go wrong? The only thing we ask is you hang around for 6 months, and then if you don't like it, you can cancel. But check it out at noteumbrella.com. That's noteumbrella.com. That's our WCN membership. Get looking at assets today. Start putting your fingers on the trigger to pull the trigger on some note deals here before too long. Yes, anybody can buy notes. I don't care your age, your savings, what race, color, whatever it is. Note investing is all about what action you take, and the first action you should take is signing up for our monthly membership at $97 a month. That's noteumbrella.com. You can also access it by going to weclosenotes.com and checking on the monthly membership. But we are here to help you. Scott Carson, the Note Guy. We look forward to seeing you at the top.